My name's Tom Jones, Profit First Advisor, business coach, and tax planner. Here's the truth. Business can grow, but they get into that 6 or 7 figure, they get excited about their revenue. They're going gung-ho, like this client that I worked with this last week. They've got this growth. Their revenues are going astronomical. They get 6 or 7 figures of revenue. Then April comes around and the tax return gets done and they go, boom, what happened here? Because all of a sudden they have a big tax bill, 35, 60, sometimes even $120,000 in taxes, depending on how big a growth they had. And then they say what to me? They say, why didn't my tax preparer tell me about this so I could avoid this? It's a two-way street, but the big thing is people got to remember is that when you go in and you just bring the information and they're just preparing your taxes, they can't go back and see what you did to get to that point for taxes. All they can do is say, hey, here's what's happening now. If you have extreme revenue growth, you need to plan. These preparers, 95% of them are just filers. You bring the information in, they file the taxes, they give you the results, and then you kind of go, what happened? I talk to my clients, depending on how often they want to talk, I talk to them monthly, quarterly, semi-annually, at least to get an idea of where they're at tax-wise, so I can let them know what's going on, if there's something we can do, if there's not. But then I've got other clients that come in once a year, and they ask me what to do, and I tell them every year, if you would come in August or September, just so that we can see kind of where you are throughout the year, we can help you out. But if you come in after the end of the year, the results are what the results are. We can't, there's a few things you can do, but not many. So keep that in mind when you're in that high revenue growth stage. So we're going to talk about an audit myth that people think about. You don't get audited for taking legal deductions. You get audited for messy books, inconsistent reporting, lifestyle not matching the income, you're putting debt on everything and where's this income coming from, or big deductions with zero backup. What that means is you should be documenting everything. Clean books, audit protection. Are you keeping up on your books? Do you understand where you're at? Are you having to catch up at the end of the year? It's not good. You should be on your books all the time. One, it helps you run a better business. And two, it will help with your audit risk because you can show them saying, hey, I keep up on my books all the time. Here's my documentations. Bottom line is the IRS isn't out to catch you. They're just doing their job. If they see any inconsistency, they're going to make you look at it, and they're going to catch those people that have the sloppy records, don't have documentation. So let's talk about some strategies that you could use to help lower your tax, to get some tax savings during the year. I mean, these are smart, low-risk strategies that you can implement even before the end of the year. One of the big ones, have you looked at your entity? If you're a business, have you looked at the entity? Are you sole proprietor, an LLC, single-member LLC, and you're making over $100,000, $150,000 a year? You might want to consider switching to an S Corp. You can save money on that with the self-employment taxes now. Before you think, well, geez, I can save a lot in self-employment tax. You have to pause here. The IRS looks at one thing with S Corps. Are you paying yourself a reasonable compensation? What that means is there's studies out there, there's companies out there that will let you know, saying based on the job that you do within the company, not just being the business owner, but what jobs do you do within the company? Is that a reasonable compensation for what you're doing? If you've got the documentation that says, hey, my job is XYZ, based on XYZ, here's comparable compensation in this area for that type of job. And if that's what you're taking for wages, great. You've got a reasonable compensation study that shows that you're taking reasonable compensation. Anything over and above that can be considered a return on your investment. So again, that is a big step you do not want to skip. Now, done right, this is one of the most powerful tools you can use out there, converting from an LLC or sole proprietorship to an S Corp. Keep that in mind. Another thing people miss out on or don't know about are accountable plans. Do you work from home? Then you're leaving money on the table if you're not reimbursing yourself with an accountable plan. Think your internet, your cell phone, mileage, your home office use. It's all 100% legal if you document it and do it correctly and make the documentation. Third step, this not only applies to business owners, this applies to individuals, high wage incomes. Are you doing retirement contributions? Are you maxing out your retirement contributions? You've got SEP IRAs for your business clients. You got solo 401ks, you got simple IRAs. For high wage earners, you got to look at your company. Are you able to max out your 401k contributions? Are you putting in an IRA if you don't have a retirement plan at work? That all of that reduces your taxable income. They're not just retirement savings tools, there's massive tax shelters because every dollar that you put into a retirement plan reduces your taxable income. And the IRS likes seeing that because that's what you're doing. Excuse me. Next thing, strategic timing. If you're on cash basis accounting, this is back to just being for businesses, you can shift income and expenses. Example, it's December. You can prepay your January rent. You can knock out subscriptions early. You can pay a contractor in advance. You can actually pay utilities in advance. All of that lowers this year's taxable incomes. Now, there's IRS rules on what you can prepay and what you can't, so make sure that you're doing that correctly. The other side of this is if you're on accrual, the rules are different, so check before you use this one. But for cash basis, this is accounting 101. Prepay those expenses to help lower the income for the year, especially if you have big expenses that you could have paid in January or come a member LLC and you've got kids, did you know you can hire your kids that are doing legitimate work and not pay taxes, have them pay taxes, and you get the deduction for it. And you don't have to pay self-employment taxes on it. Again, it has to be legitimate work. They could be doing bookkeeping for you. They could be doing cleaning. They could be stuffing envelopes. They could be running your social media, because we all know that kids are easier running social media than us older folks. And if they're under 18, you can pay them the standard deduction amount. That's up to 14.6 in 2025. Now, again, you have to document it. How many hours did they work? What did they do for you? And so on. You deduct the wages. You pay zero federal income tax because you only pay them up to the standard deduction. You get a deduction which lowers your taxable income. And then you can take that money and you can put it into a Roth IRA for them, college fund, or even just a separate savings account so that they have access to it. And, since they're under 18, technically you're their legal guardian. So you kind of have control of that. But again, talk to a legal representative on that. Now, a small caveat on this, you got to be a sole member LLC or sole proprietor. Because if you're an S Corp, you will have to pay the payroll taxes. But again, if you're that sole proprietor or single member LLC, this is fantastic, IRS approved strategy. Bottom line, these are like simple strategies you can use to reduce your taxable income this year, reduce your taxes, get reimbursed for things. But bottom line, documentation is everything. None of this is about hiding money. It's about tracking it. You can't just come up with a deduction, put it on your books and take it. You got to have documentation for it. IRS comes knocking at your door. You can pull out that documentation and say, look, I did it. I put everything XYZ for you. They'll look at it. I mean, yes, it may be uncomfortable, but if you've got everything documented, there's nothing to be afraid of. They'll do their job. You do your job. So keep those receipts, keep logs. I went out to dinner with so-and-so. Here's the business items we discussed. It could be as simple as that. Use a mileage app. Make sure to keep good payroll records. And most importantly, keep your bookkeeping current, because you can't go back. If you're trying to catch up for a whole year, and all of a sudden there's some item on your things, you're going back and you're looking at everything and you look, what was this for? Who's going to remember that, a year later? You might be able to. If you've documented it, no problem, and you kept your books current now, you would know for sure what it is right away. So keep that bookkeeping current. But let's kill another myth right out there. If I take too many deductions, I'll get audited. No, you won't get audited. If they're legitimate deductions that you can document, there's no reason why you can't take them. Remember, there's always got to be a business purpose for them. You can't just deduct it to deduct it. The real audit risk comes when you have poor records, you consistently file your returns late, you're inconsistent in your reporting, your payroll's all over the place, it's not consistent, or you're rounding numbers to the nearest 100 instead of using the actual numbers. Again, the IRS isn't out to catch you. They're just doing their job. They're making sure that you're reporting all your income, taking legitimate deductions. So big things, they're just out to catch sloppy books. But if you document, keep receipts, keep your bookkeeping records clean, if the IRS ever calls, you'll be ready. And you won't be panicking because you've got everything. They can ask you for something, you can give it to them. Because you've done all your documentation, you've done all your due diligence. So we're going to recap this real quick. I'm going to write it down here for you. But again, my sloppy writing will be here. The number one item, keep clean books. And the easiest way to do that is to keep them current. Don't wait 6 months or a year to get your bookkeeping back up to date. 2, tax plan before you do your tax return. Again, you can't do anything in April the following year, but if you talk to somebody right now, you still have time to do something. Don't wait. Do your planning now. 3, if you can document, take the deduction. Don't be afraid because you think it's too big of a deduction. If you document it, business purpose, everything else, take it. 4, we talked about this. Do you have the right entity structure? A lot of that can be changed. Last but not least, work with a tax planner. You can stay with the same preparer you're with, but work with a tax planner. The preparer can still take everything and put it into the correct forms and everything else. Work with a tax planner. They'll help you save more money. And then you can still use the same preparer if you want. If you have a good relationship with them, you can come see me for tax planning. I'll let them still prepare the return. I'll help you with the planning, tell the preparer what to do, and they can do it. You don't have to ruin that relationship, but you can build a new one that may save you a lot more money. So those are the items that I help with business owners that I work with. I can help you clean up your books, build a strategy that works, meet quarterly, monthly, and make adjustments, and create a financial system that supports your goals. Again, all this is planning side. If you have a bookkeeper, you have a tax preparer that you love, that you want to stay with, you have a bookkeeper that's going to do good work, it's fine. They can still do all that work. I'm going to take you to that next level and help you plan things, save money, make your life easier for yourself so that you can plan your business instead of worrying about planning for what could happen online. Because we've already done that planning saying, okay, if X happens, you do this. If Y happens, you do that. So if you're ready to stop dreading tax season or even just taking care of your books, I can help you. I can help you with tax planning. can help you with cleanup work. I can help you with full CFO support. And I can even we can even just do quarterly strategy calls. It doesn't even have to worry about, this can just be talking about things. It doesn't even have to be looking at your books. We can just talk about things. There's a level that fits with you. I work 4 ways. I work with tax representation for people that fall way behind on their taxes, tax planning, your business planning, and profit first, making sure that your operations are working good. All right, that's it for today's live. Thanks for hanging out with me.